I'm Jim Schultz, and this is From Theory to Practice. Welcome to the Wednesday edition of the show. Welcome to the pre-recorded edition of the show. This is not live. I think maybe the magenta shirt on back-to-back days was a giveaway that this is not live, but I'm still here with you all because I know, guys, I know that you are tuning in today for one thing and one thing only. You want to make some money. How are you going to do that? You're going to do that with Nvidia earnings. Even more specifically, how are you going to do that? You're going to do that by doing the opposite of what I'm going to do. So even though I can't be there with you live today, I am off on a secret mission. I'm not going to let you guys down. I got a little something for you, but we have to do a little educational content first. So hang with me for the next 4 to 5 to 24 minutes, and I will get you guys all set and squared away on some Nvidia earnings. But before that, let's talk about choosing an earnings strategy. So this is going to be very much a broad overview. This is going to be very brass tacks, like you're just getting started. Maybe you're a new trader. You're trying to kind of find your way around, these earnings trades that you see us all do here on the network pretty much every single day. Obviously, it's going to be a lot heavier during earnings seasons, but most of the time there's something happening one way or another. So what I want to do here today, let's talk about how do you choose an appropriate earning strategy for whatever stock you might be looking at. So let's do that for the next couple of minutes, and then we'll send you guys on your way. So why trade earnings to begin with? So earnings announcements are they're a favorite amongst all of us here on the network, and the reason why is because they essentially give us 3 different tradable things. So number one, you have quarterly occurrences, right? Every quarter, like clockwork, stocks are going to be reporting earnings, right? These guys are going to be coming out usually January, April, July, and October. Those are going to be your heavy months because they kind of follow, the calendar year in that way, where most stocks are going to be reporting in about a 2 to 3 week window, usually end of January into early February, end of April into early May, end of July into early August, and then the end of October into early November. It's going to be kind of the heavy earnings window. And so it's really nice to have these things on the calendar every quarter because they certainly give us plenty of opportunities to stay engaged with the market and trade some of our favorite stocks or what have you. Number 2, they're binary events. They're binary events in nature. Just by their very structure, they are going to be very binary in nature because there's going to be a significant chunk of new information coming out about a given stock in a very short window of time. This is always setting the stage for a potentially explosive move one way or another. And so binary events on the calendar, earnings calls, FOMC, jobs numbers, whatever the case may be, these are some of the more common examples of binary events, and earnings definitely belong in that category. And so because of that, it certainly gives us an opportunity to trade that event, whether we want to be on one side of the market, whether we want to play it just totally neutral. We'll talk about all that here in just a couple of minutes. But then number 3, which is very much a piggyback off of the binary events, these are also high volatility events, right? As traders are getting ready for the earnings to be released, whether it be Home Depot, whether it be Target, whether it be Nvidia, right? Everybody's waiting to see what's going to happen with the stock. Like, which direction is the stock going to move? What are the numbers going to look like? The revenues, the earnings, all the other stuff in between, the guidance. Like, is there anything new happening that they're going to tell us about? All of these things kind of come out into the market at one moment in time. And so leading up to that moment, there's usually, almost reliably so, a bid in volatility as you get closer and closer to that earnings release. And so what that means is this is naturally going to be a high volatility opportunity for us, and we are high volatility traders. Like, we like selling premium in high volatility stocks. We like selling premium in high volatility environments. And so you can already see that there's a number of things, or at least a couple of things, that are working in our favor, and they kind of work to our advantage. But it's been said before, for every gimme, there's a gotcha. Okay, I got high volatility. That's certainly a gimme. Where's the gotcha? Well, the gotcha is right there in that green box. You have to be very, very aware that you understand that you are potentially walking into the lion's den. Like, you have to understand that this thing could really cut you if you're on the wrong side of the market and it gets away from you. Like if you're playing it to the upside and it crashes, that's not going to be great. If you're playing it to the downside and it rips higher, that's not going to be great. So you have to understand the nature of the beast that you are engaging with. So I just want to be, very clear about what earnings are. They are certainly binary in nature. They're high volatility events, and you just have to be keenly aware of the potentially explosive nature of whatever moves might be coming next. Okay, but what strategies should you consider? Well, this is not intended to be an exhaustive list, but it's just a little something to get you started. Defined risk and undefined risk. So should you consider defined risk or should you consider undefined risk? Well, when it comes to defined risk strategies, those would be like vertical spreads. Those would be like iron condors. Those would be like your time spreads, calendar spreads, diagonal spreads. Undefined risk strategies, short puts, short strangles, ratio spreads. Again, this is not an exhaustive list, but I would argue that these are going to be the 6 most popular strategies or strategy categories that you see us utilizing on the market or in the market on the network every single day. Okay, how do you decide what to choose? A couple of things. Number one, if you're just starting out, like if you are brand new to trading, welcome aboard. You have a very exciting / terrifying adventure that lies before you. I'm very excited for you. I would only do defined risk to begin with. You don't need to be a hero. It's not a competition. It's not a race. I would just get your feet wet, build up some experience, and then maybe sometime down the road you can consider some undefined risk strategies around earnings. But if you're just getting started, I would absolutely stick with defined risk strategies. Okay, but going one step further, if you want to take a directional shot in the stock, this would be like a short vertical spread. This would be like a long vertical spread, right? Short vertical spread is typically a higher probability play, still kind of a directional shot, but much higher probability than maybe like an at-the-money long vertical spread. That's going to be essentially a 50-50 shot. If you're going to take some type of directional stance in the stock, expect to move butterfly is obviously a strategy you guys see me use all the time. You might even see it here in a couple of seconds with Nvidia, but you've got to stay tuned to find out if that is true. Here, this is where utilizing the front week, so whatever week you happen to be in for that earnings, it's definitely on the table. So if you're doing pretty much anything defined risk, but especially something directional, so again, short vertical spreads, long vertical spreads, even of course butterflies would fit into this category as well. Using the front week, so this would be an option expiration cycle that only has a couple of days left, that's definitely going to be something that you can certainly consider. But you don't have to do that. So keep in mind, you can also just use the earnings date as a bit of a catalyst into a normal cycle trade, into kind of this 45-day window where we would just do something normal. We would just do something kind of regular that's not even necessarily associated with a binary event like earnings. And so if you want to kind of slow everything down and have everything move a little bit more gradually and methodically, choosing that 45-day regular cycle is going to be the preferred option. So regardless of what type of strategy you choose, defined risk or undefined risk, you can kind of pick the front week or the regular cycle. Now, how do you decide? Well, there's a couple of things to consider. The main one is this: how fast do you want your results to actually materialize in the strategy? If you choose the front week, it's going to be very, very quick. As our guy Errol Coleman says, it's going to be instant pain or instant gain. And so if that's the type of game you want to play, again, with defined risk, so you know the worst case scenario, then go into the front week. Do something with only a couple of days to go. That's totally fine. If you get the move right, you're going to get paid really quickly. If you get the move wrong, it's going to be more painful. But if you stretch that out into a regular cycle, now all of a sudden, even if you get the move right, you're not going to make that much money. But if you get the move wrong, you're also not going to lose that much money. And so, of course, it kind of goes both ways, and it's gimmies and gotchas like it always is. But what about undefined risk strategies? So maybe you've been trading for a while. Maybe you've built up some experience, and you're ready to kind of dip your toe in the water with undefined risk strategies around earnings. So short puts, short strangles, ratio spreads, jade lizards, right? Strategies like that. I would not do any of these strategies in the front week. I would only do these strategies in the 45-day cycle. And the reason why is actually quite simple. It's twofold. Number one, if you're selling premium, so short put, short strangle, ratio spread, etc., if you're selling premium, you're not going to get paid that much in the front week relative to what you could collect if you went out to 45 days or 37 days or 51 days. That's just the simple nature of extrinsic value. You always get more extrinsic value the further out in time you go. Now, of course, that means you have to carry the risk for a longer, window of time as well. But it increases your break-even point. All the Greeks kind of slow down. There are a number of advantages that kind of come alongside that. And so when it comes to, undefined risk, you're collecting more, and so you don't necessarily have to worry about having these super tight break-even points in the front week because you didn't collect very much. But then also number two, and I alluded to this just a second ago, when you choose the front week, instant pain, instant gain, you are actually engaging with the Greeks in your strategy. So delta, but specifically gamma, you are engaging with the Greeks at essentially their highest point over the course of the entire expiration cycle. And so if you do get the move wrong, it can be very, very painful very, very quickly. And remember, this is undefined risk. There is no safety net. There is no training wheels. You've got to be ready to go in terms of the management, the contingency plans, all of that stuff has to be ready to go. And so I would much prefer to see you do something in the longer dated cycle with the 45 days to go, because even if you get it wrong, it can still be painful, but man, it can be a whole lot more painful if you do it in the front week and you're just not being compensated for that, in my opinion. Okay, now, this is what you guys want. If you're watching this live tomorrow, then you're getting it. You're getting it exactly when you need it. If you're watching this after the fact, like on YouTube, then you missed your shot, man. You missed your opportunity to fade me and make some money. But next time, don't let it happen again. Here you go. When you think about Nvidia, think about it as an idea. Think about it as a way of life, right? Think about it as a philosophy. I just don't know how you can possibly look at Nvidia and be anything other than mega bullish. Do you really think that Nvidia is going to let the market down? The market's been sliding for days. The market's at least 4% off of all-time highs right now. The fear index, it hasn't seen levels like this. It's been at least 2 weeks. Do you really think that Nvidia is going to let the market down? There is no way. There is no way. I'm 19% sure of it. There's no way. So we're going to play an expected move butterfly. Now, I am not doing the trade now. I'm going to do the trade tomorrow, which for you will be today. I'm recording this on Tuesday after the From Theory to Practice episode. But here are the details that will surround my trade. I want to wait and get the right strikes just before the close. So number one, I'm going to choose a 12.5 point wide butterfly. I was looking at it earlier, and that looks to be a pretty good butterfly width for what I'm trying to accomplish. I'm probably going to end up paying about $2.50 or maybe $3 for that. Number two, of course, I'm going to have my short strike be pinned right at the expected move to the upside. And so we're obviously going to be playing this thing up. We're going to be playing this thing higher. I will put my short strike or short strikes, because there'll be two of them, and I will pin the expected move to the upside. And then number three, I'm going to do this trade in the final hour of the trading day tomorrow. So you guys will see this on the follow page. And again, what should you do when you see this on the follow page? What should you do when you see this in the From Theory to Practice time slot? You should do the exact opposite. You should fade this trade if you're very serious about making money today. And so there you go. There's a little bit about choosing an earning strategy, and we'll see you guys next time.